Welcome everyone to Milestone Investing 1 hour webinar, and today's subject is secure strategies for rapid wealth building hidden by the wealthy. Now that's a very provocative title, because what on earth could be the wealthy be hiding from everybody else? Well, we will find out soon enough. What I'm suggesting is something that is not known to all of us, but certainly would be incredibly beneficial if it was. Let me tell you a bit about myself. My name is Miles Thomas. I spent a number of years in the 1980s and the 1990s as an accountant, and I really enjoyed what I was doing. But at some point I discovered, when I started to invest in companies, that I really didn't have any shares in the organization I worked for. And fair enough, I would have had a pension, but my pension was never going to make me a wealthy individual. And so, but because I was investing and I was seeing the results of certain investors, it made me obviously pay attention to another particular paradigm. And one investor who was on my radar at the time was a man called Warren Buffett, who today I believe is the third richest man in the world with a valuation of about 70 billion. And he took about, I think, 50, 60 years to get to that number. And it's interesting because he said something really interesting. He said he knew, with some information he was taught from his father, he knew that if he lived long enough, he would definitely be a billionaire. And so the question is, what did he know that gave him such certainty as a young boy? That information I'm going to reveal to you today. So on my journey as an accountant, I decided to basically just go and do some studies in investing. And I went to America in the year 1997 to basically learn psychology and investing and a range of other subjects. And I came across a particular teacher called Wade Cook, who at the time was based in Washington, Seattle, Washington. And he was teaching options trading, the American style options trading. And I believe within about, in fact, he was the one who opened my eyes, okay, at the time. So let me set the scene. My bank at the time, my building society then, but bank now, was Halifax. And in the shop window, they were advertising their interest rates. And it was basically, they were advertising, and in fact they were boasting that they were paying 5%. Now today, anyone paying 5%, that really would be a boast. But anyway, they were boasting they were paying 5% interest to anyone who had an account with them. And you know, me in my then wisdom thought that was about right. 5% a year is a decent rate. And so I'm now on this course in Seattle, and once we start to do the trading, and we're trading in the classroom itself, it's a 4-day course, and we're in the classroom itself, and I make 10% in 1 day. And all of a sudden, you know, I did the maths, and all of a sudden I thought, hang on a second, if I can make 10% in 1 day, why on earth would I give my money to Halifax for 365 days to give me 5%? And at that point, that's when I realized this didn't make sense. And I had to be in the classroom, and I had to see it for myself, because here's the truth. Had anyone told me this was possible, I wouldn't have believed them. I had to do it and see it for myself to know it was true. I'm one of those people. I don't really believe you if you say I have to experience it. I'm one of those types. And when I saw it and experienced it for myself and knew it was true, I was sold. Okay, and so I came back to England, and I basically just did some converting of the things that we learnt in America into the UK style, and I did some research. And initially I did my studies on the UK stock. Took me to about 2,000 companies, 2,000 biggest companies in the UK, and I did my research on those. And then I whittled it down to the top 350, and then I realized the top 100 was the ones that was kind of where the real action was. And so this is basically what I want to show you the things I learnt, and and I want to basically make it basically something you know. And so that's the goal of today. Now, when I was in the States, I came across a number of characters, and one of them is a man called Robert Kiyosaki. He wrote a book called Rich Dad Poor Dad, and he became quite famous for that. And he wrote a number of other books too. But this is a letter that he wrote to me back in 2015. And it says, "Greetings, Miles." And then he goes on to say, "One of the big mistakes investors make is investing like a gambler. What most gamblers do is they keep gambling, hoping their luck will improve. You'll hear them say, 'Come on, lucky seven.' And if they do not get the lucky seven and lose their money, they simply try again. 'Come on, lucky seven.' Many people invest the same way. If their stock goes down in value, many will acquire more, saying, 'Acquire while the stock is cheap.' Trading stocks because they're cheap without understanding technical or fundamental trading is nothing but gambling. As Rich Dad said, investors know the way. Gamblers hope and pray." And so the key here, what I want to bring to your attention, is that the idea is that we don't want to develop a strategy of trading or investing which really puts us in the realm of gambling. Because when you gamble, you will win sometimes, you will lose sometimes. But I don't know a single gambler who always wins and never loses. I don't know that person. They may exist, but I've never heard of them. And so if you want to actually take advantage of one of the secrets if we want to take advantage of one of the secrets that Warren Buffett knew when he was a child, then you're going to have to come with something that has a high probability of success in your favor. And so with this in mind, I want to show you something today that I think can actually make a difference to those of you who are paying attention today. All right, but before I go into all of that, I want to just cover some fundamentals. It's almost like house rules, okay? And this is the first one that we should pay attention to, and it's called the poverty formula. Some of you may have heard of it. Some of you may even be practicing it, but here is what it looks like. You earn less money than the cost of your lifestyle. Now, you might say, "I don't have a lifestyle." Trust me, if you pay for your bills, your rent or your mortgage, your mode of transportation, whether it be the bus fare or a car, whether you have mobile telephone, and so on and so forth, all of your bills, whether you have a large lifestyle or a small lifestyle, it doesn't matter. All of that is lifestyle. Now, some people's lifestyle affords them luxuries, and some people's lifestyle affords them no luxuries, but it's their lifestyle. So here we go. You earn less money than the cost of your lifestyle. And the gap between your lifestyle and your earnings, you borrow that. Now that could be on your credit card. And that could be a loan from some institution or somewhere else. But that loan and that credit card adds another bill called interest. And then if that starts to accumulate against you, you start to experience a problem which most people suffer from when they live this lifestyle. And in the long and short of it, if you follow this program for long enough, you will end your years. You will start your working years in your 20s, and you will get to your 60s and you will have nothing. You will spend 40 years working and have nothing to show for it. And this is how you pull it off, if that's the way to go. Now, some people might say, well, hang on a second, I'll just get a bigger job, more money, and so I'll just get promotion. And here is the problem with that, according to Dave Ramsey. Unless you control your spending, making money won't help. You'll just end up with bigger payments or bigger bills. And I'm going to tell you a quick story. I used to work as an accountant in one hospital in London. It was St Thomas's Hospital near the Houses of Parliament. And I got a promotion and I moved to a hospital called Great Ormond Street. And my salary practically doubled, okay, in that move. And so you would have thought, okay, if I could survive on the first salary, then the second salary would have given me lots of excess, income. But the answer is no, because all I wanted to do is spend it. I wanted to get a bigger car, a bigger house, a bigger everything. And all I did was just make my expenses match my new income. That's all I did. And that's a prime example. Now, even though I was an accountant, I was still sucked into that mode of behavior. And the truth is this: most people spend everything they have, not because they're foolish, not because they don't have their cerebral cortex is not working correctly. That's not the reason. They do it because they're almost like trying to solve a problem they have with their, I don't know, some trauma they had in the past from being poor or something. But it's an emotional reason that makes people spend money and never have anything later on. They're doing it for emotional reasons. And it's these emotions that we are feeding, and that's what causing the problem. Okay? Let me look at the other side of the scale. So we looked at poverty. What does wealth look like? Wealth says this: earn more than the cost of your lifestyle. And the difference? Invest the surplus on income producing, appreciating assets. So what do those words mean? Well, an asset that gives you an income. So if you've got a rental property, that income would be rent, obviously. And an appreciating asset, that's an accounting term, and that means that the asset is going up in value. So you buy it today, or you buy it, say, 10 years ago for, say, 200,000, and 10 years later it's worth $500,000. This is an appreciating asset. A depreciating asset is an asset that goes down in value, okay? But an appreciating asset goes up in value. Okay, now, the key part of the formula is actually hidden inside your assets. So, a long time ago, I read a book called The Cash Flow Quadrant by Robert Kiyosaki. And in there, he was talking about a number of ideas, but he described assets as being something that puts money in your pocket. Now, every accountant on this call, or every accountant in the world, knows that is not the accounting definition of an asset. An asset for an accountant, and remember, your accountant does your books for you, so practically everybody is following the accounting definition anyway. If you've got a business, you're following the accounting definition because he's doing your books. And he will tell you that an asset is something that you own or control, something that has material value. Material means significant value. And you're going to have it for a period of time in your possession. And that's a definition. So what's an example of that? Your house. The house that you live in has a significant value. Number one. Number two, you own it. And you're going to have it for a period of time. And that's it. That's your asset. Okay? So I want to look at a paradigm shift that really was the one that got my attention and opened my eyes completely. And if you get this will serve you well. So if you've got pen and paper, this is you want to grab this information. Okay, here we go. This is what I'm calling my asset analysis. My asset analysis table. Let me just get a pointer here. Okay, for some reason, it's not obeying. This thing's not obeying me. But anyway, I'll continue. If we look at everything in this column, 2 and 4, it says net expenses. Sorry, these are all these assets. Sorry, beg your pardon. These are assets that cost you money because you own the asset. So every month or every whatever the period is, it costs you money and you got to pay for it. These assets in this column, 1 and 3, these assets give you an income because you own them. The assets in this row, 1 and 2, they go up in value after you've purchased them. And 3 and 4, they go down in value after you purchase them. Now, let's look at number 4. Number 4 is your own home in a down market. Now, what's a down market? Well, the property market kind of basically goes up and down in waves. And so, for those of you who are above 30, you might remember in 1989, Margaret Thatcher was the Prime Minister of England, and her Chancellor was Nigel Lawson. And in 1989, the housing market hit a peak, and then after that, the prices started to fall from 1989 onwards. So 1990, 91, 92, they started to fall, and they kind of fell and hit the bottom around 94. Around that time, 94, hit the bottom, and it stayed on the bottom for about maybe 2 to 3 years after that. But what was interesting is that anybody who bought their house in 1989, 3 years later, found that the house was worth less money than they paid for it. So that's a down market. The house has gone down in value. Okay. Another example, and obviously your house goes down in value, you're paying the bills. You're paying the mortgage, you're paying the utility bills associated with your property, you're paying the council tax, you're paying insurance on the building and on the contents, you are furnishing the building to make it habitable for yourself, you're decorating it when you need it to look the way you want it to look, etc., etc., etc. So even though you have this house, it costs you money just because you live in it. And then a car in that box, car for personal use. You buy your car and you drive it for yourself and you use it for yourself. This car will go down in value over time, and that reduction in value is known as depreciation. And so this is the nature of these things. Now you might say, well, hang on, my car doesn't do that. Well, if that's true, then that's because your car is a vintage collectible car. But unless your car is a vintage collectible, your car is going down in value once you've purchased it and it's been in your possession for a period of time. Number 2 is your own home in an up market. Now remember, I told you the market was up in 1989, it fell to 94. From 1997 onwards, house prices started to rise again. Okay? Now, anybody who bought a property before 1997, everybody in this country anyway, their houses went up in value from that point onwards, up in value. And so had you bought your house because you timed it correctly in 1997, then you were in an up market. Okay? Now, but it's generating expense for you. So even though the house is going up in value from, say, maybe 300,000 to maybe, let's say, £1 million, it just goes up in value, and you've made a nice capital gain on it. Because you live in it, every single month, that property is taking money out of your pocket for the mortgage payments, for the utility payments, and so on and so forth, as we described earlier for number 4. So what we have here are assets in 4 that go down in value and cost you money to own it, and these one go up in value and cost you money to own it. That's that category. Number 3, and Robert Kiyosaki calls these assets liabilities because they take money out of your pocket. Okay. Number 3, these are assets that go down in value, but they give you an income. And so the rental property and down market, we explained what that was earlier, but it's giving you income. So the rent money is coming in. A business where the profits over time are reducing. There's a company called Pearson's who basically publish a newspaper called the Financial Times. And over the last 5 years, their profits have been going down and down and down and down. And last year, they posted a 2 billion, with a B for Bravo, £2 billion loss. And they've been just going down, and obviously if they continue falling, they won't stay in business, obviously. So they're going to have to turn that around at some point. But the point is, this company in the last 5 years have been going down and down in value to the point where we've now gone negative. That's an example of a business where the profits are reducing. Okay, but the thing about them, they're paying you a dividend. So even though they're losing money, they're still rewarding their shareholders for being loyal to them for holding on to their shares. A taxi driver, well, he owns a car and the car goes down in value. But because the taxi driver earns an income from his cab, you've now got this asset, which clearly is going down, but it's generating an income, which is basically making it worth his while to have this taxi cab. And then the last one, you've got cash in the bank. Now, this may be obvious or not so obvious to some. So let me explain. Cash in the bank goes down in value. In fact, cash is an asset. Cash is actually an asset. But this asset goes down in value over time. And when it goes down in value, we call that inflation. But that word inflation is really a misnomer, because inflation means you're inflating something, which means it's going up. If I inflate a balloon, I'm making the balloon larger. Okay? So why would we name the devaluation of money inflation? And it's basically, I don't want to say a sleight of hand, but let me just say it this way. Imagine a seesaw, and there is a child, a 5-year-old child on one side, and their parent on the other side. The child sits on the seesaw first, and then the parent sits on the seesaw. And when the parent sits on the seesaw, because the parent's heavier, the child goes up. So I want you to imagine the child is a loaf of bread, and the parent on the other side is money. When the parent sits down, the money is going down. So even though the bread appears to be going up, it's going up because money is losing its value over time and going down. I'll give you an example. In the 1970s, if your mother sent you out to buy a loaf of bread for the family, you would go to the shop and you would buy the bread for about 10 pence in the 1970s. And this bread would have had about 30 slices in it, okay? Same as it is today. Now, today, that loaf of bread is about anywhere between £1 and £2 for that same 30 sliced loaf of bread. All right, so let's go with the cheapest version of that, because we didn't have all these fancy ones back then. So let's go with the cheapest version of that, and that's a £1 loaf of bread. If we compare the £1 loaf of bread to the 10p loaf of bread, what's happened? Well, money has gone down in value by 90%. And that's why you could get more bread with the £1 in 1970 than you could get now. So for example, one pound today buys you 1 loaf of bread. £1 in 1970 bought you 10 loaves of bread. 10 loaves, not 1. And the reason why that's the case is not because bread has gone up, money has gone down. Money's gone down. But the bankers and economists and everybody else who's an expert get us to focus on the child on the seesaw going up, when really the problem is the parent on the other side is coming down. The value of money is being lost in the system, and they do that essentially by it's called the fractional reserve banking system is really the culprit here, and then when you couple that with quantitative easing, this is what's causing that particular phenomena. Let's go to number 1, category 1, a rental property in an upmarket. Well, we know what the upmarket is, okay? We discussed that earlier. And this property that goes up in value is paying you an income called rent. Another example, you've got a business where the profits are increasing. And why do I pick on profits? Because the value of the business is based on profits. And so if you take profits multiplied by something called the PE ratio, that gives you the value of the company. So I'll give you an example. 1,000 times 20, right, is 20,000. So if I've got £1,000 of profits, and my company is valued at a P ratio of 20, then my valuation is 20,000. 1 times 20, 20,000. That's roughly one way of giving you a valuation. All right. And so an example of a company where it's been going up and up in value over time is Taylor Wimpey. And Taylor Wimpey is a building firm that makes obviously new houses. And they've been going from strength to strength in the last 5 years. And they also pay you a dividend. And in the case of Taylor Wimpey, they pay you 3 dividends a year. The first one is called the interim dividend. The second one is called the final dividend. And the third one is called a special dividend. And these 3 dividends is what this company, Taylor Wimpey, rewards the shareholders for keeping the company and for keeping their shares. This column of assets put money in your pocket because you own it, using the Robert Kiyosaki definition. So let's go back. All of these 4 things are assets according to an accountant. But according to Robert Kiyosaki, these 2 assets are liabilities, and these 2 assets, or these 2 asset classes, are assets, using his definition. Okay? Right. There is an accountant in Australia. His name is Brad Sugars, and he's written a book called The Trainee Billionaire, I think it's called. And he goes one step further than Robert Kiyosaki. He says these words, or he says this: only invest in number 1. Only have this on your shopping list. When you want to go to buy assets, only have number 1 in your shopping basket. And do not have these ones in your shopping basket when you go asset purchasing. And how do you do that? You ask yourself 2 questions. Number 1, when I buy this asset, will it go up in value in the future? If the answer is yes, tick number 1. And number 2, while it's in my ownership, will it give me an income? If the answer to that is yes, then you've got a class 1 asset and go shopping. All the others, he says, leave them alone. Now, why would you leave number 3 alone? Because number 3 requires you to have the skill to make sure that the income is greater than the reduction in the value on the asset. So you've got this balancing act going on. And for this one, you need an element of savvy. And so if you focus on number 1 only, even if you were an idiot, you would do well. You would do well with asset class number 1. And I think I want to leave it there. So this is the key lesson here. Focus on these ones. Okay? Now here's a question. Well, hang on, but I've got to live somewhere. Yes, you can live somewhere. You live in your own home and you have your own car, but don't call it an asset. It's just your stuff. It's your stuff. Okay? It's your stuff. And you need to have them clearly, but it's your stuff. I just jumped ahead of myself. So let me stay there. So that's basically your stuff. All right. So let us go now to talk about precisely what it is this secret that is hidden by the wealthy. Now, the whole subject matter is not a secret, but how you can actually use it. And I'm going to show you examples, real examples, of how you can use it to actually make your wealth grow significantly. This is the part that is not known by everybody, and I'm going to show that to you today. Last year, December 2016, the City AM basically had this particular headline, and the City AM is a newspaper that is published really by the City of London, and they basically discuss, it's really a business paper, and it's a free business paper. And if you live in the middle of the city, or if you live near a tube station on the outskirts of London, you'll get this paper. If you live in another city like, I don't know, Sheffield or Birmingham, you may not get the paper, but certainly in London you do. The newspaper headline said these words: FTSE 100 companies are expected to shell out nearly £80 billion in dividend payments next year. The next year they were talking about was 2017. So they're telling you that the top 100 companies in the UK are going to give free money to their shareholders just because they own those shares. To the tune of how much? To the tune of 80 billion. All right. So how do we get access to these shares, and how do we know which are the best ones to go for? Well, we actually use and read and subscribe to a newsletter called the Milestone Investing Newsletter. And what this newsletter allows us to do is to identify the relevant companies that are paying dividends and which ones are the best of those choices to give you a return on your money, and which ones are likely to give you back your money with the dividend in the quickest possible time. Okay, and let me show you an extract of such a newsletter. On the 9th of March 2017, this newsletter said these words, or has had this table in it, and in it it said BHP Billiton, a mining company, it said was going to pay a dividend of 32p. The share price was in this range, 1,362.5p. What does that mean? It means £13.62. So if you spend £13.62, you get 32p extra, okay? And that puts you in the range of 2.4%. Now you're going to be groaning, oh come on Miles, we know this stuff. Because, but that doesn't make, 2.4% a year doesn't make you rich. Patience. I'll reveal the secret. It's coming up. Here we go. There is a derivative, either known as a CFD, contract for difference, or you can go to its sister derivative, spread betting. And whether you use a spread betting platform or if you use a CFD instrument, you're able to get access to this share for only the price of the deposit. So this is 100% of the value, but if you look over here, this column called margins means deposit, okay? And so if you use those derivatives, you can actually get access to this share by only putting down a 5% deposit. So if I take 1362 and I multiply that by 5%, the number that pops out of the calculator is 68p. And that is telling me that for 68p, I can actually control that share. And if I control the share, it's going to pay me 32p. So let's go back. I pay 68p and I receive 32. So I get all of the dividend, but I only pay a fraction of the value. If I do that, my return on investment multiplies by a factor of 20. And instead of getting 2.4%, I now get 4.7%. I get 47%. And before you think that's nonsense, this is actually real. Persimmon is a building company. They're paying 25p dividend. To receive it, you got to pay £20 and 80p for the share. And 5%, sorry about this, and 5% of that dividend, so of that share price, is going to take you into the range of £1. And so you're going to spend £1 to receive this 25p dividend. If you do that, again, because 5% dividend you're paying down, if you do that, you're going to find that your dividend yield goes up from 1.2 to 24%. 24%. Okay? What we do at Milestone Investing Newsletter is we say anything that's going to give us 20% every week or more, we do further analysis on it. If he's going to pay less than 20%, we don't look at it. And so that might sound outrageous, but all of these companies, we don't even bother to look at them because they're too small for our particular criteria. Let me tell you, in addition to this information, we also wanted to know, okay, so I may buy this company or take on this share, but how long will it take me? How long will it take me to get my money back? And so for that information, we look at the trends of the history. What did history tell us? And so if you look at BHP Billiton in the last 5 years, this is a historic time frame. In the last 5 years, this company paid us back our money 50% of the times within 1 week. So half the times we got our money back within a week. Okay. The other half of times we obviously didn't get our money back in a week. And here is the risk associated with this one. 8% of the times, 8%. Okay, we didn't get our money back at all. So we receive a dividend, but we didn't get the actual capital back. We're still waiting around on it. And that's if we go long. What does long mean? Going long means I will put money into, I'll basically buy something, and as it goes up in value, I benefit from the increased value. Because when I sell it afterwards, the extra is mine. That's my profit. When you do something called going short, it has the complete reverse effect. In other words, if you buy an instrument and it goes down in value, you make money. And if it goes up in value, you lose money. So this one, when you go long, when it goes up, you gain, and it goes down, you lose. With this one, when it goes down, you gain, and it goes up, you lose. Okay? So if you had in that time frame, if you had shorted BHP Billiton, not gone long, but gone short, 50% of times you made money on day one, and 50% of times you made money on day 2. Okay? That's what the data is telling us. Persimmon, 67% of the time, 67, you got your money back within a week. 17% of the times you didn't receive your capital at all. And if you've gone short, 17% of the times you did well on day 1, 33% of times you did well on day 2. So they're highlighted here because it's telling us that if you're going to go long, that's the best one to go for based on its historic track record. And if you're going to go short, that's the best one to go for. Now you might say, but hang on, this number's bigger. Yes, 89% is bigger, but if you remember from the previous slide, this was a 4%er. And we're not going to look at a 4%er when we've got something on the table that's paying us 47% and 20-something%. A 4%er becomes a non-starter. All right, so how did it actually do in reality? Well, here's how it did. BHP Billiton on the long side delivered a return of 47%, and on the short side it delivered a return between 53 and 56%. Okay, Persimmon on the long side did 23%, and on the short side, at the lowest price, you made you made a loss of 7%, and on the highest price, you made a gain of 24%. So anywhere between those two numbers would have been more or less what you would expect to get, and between those two numbers, we'd expect to get. Now, let me just show you the chart itself that demonstrates this, so you can see graphically what happened. So I'm going to go to the first example, BHP Billiton. For those of you who are unfamiliar with what you're looking at, this chart, the red and the green rectangles are called candlesticks, okay? And these candlesticks represents 1 day of activity on the stock market for this particular company. And so if I was to hover over this one specifically, I've highlighted the fact that the green line represents the highest price it went to. The red line represents the lowest price it went to on that day. Okay, so we can see, had we gone long, we would have to wait it until here before we got our money back. So let's count the days. This is Wednesday, Thursday, Friday, Monday, Tuesday, Wednesday, Thursday. So you got in on the Wednesday, and 1 week later, you get your money back and you got the dividend. So in this case, we said that gave you a 47% return, and you got 47% return and you got your money back in 1 week. Not 1 year, but 1 week. Okay? Now, had you shorted it, we said you would have made about 50% or 50+% on this case. And that's because when it went down in value, the first blue line is break even. Why break even? Because when you short a company, so when you short the derivative, you pay the dividend. you pay the dividend. When you go long on it, you receive the dividend. All right? And so that first blue line represents break even. The share price has to fall by that to compensate for you having to pay the dividend. So you pay the dividend, but then you get it back as the share price falls. It has to fall to that first blue line. Now you break even. The second blue line is what we expect it to do. It's our target exit price, okay? Again, based on empirical data. But this doesn't fall to the expected price, it falls by more. And ends up giving us this little bit of a premium down here. And so we can see that you received the 50% or 50 something percent 1 day later. 1 day later, you made 50%. 1 week later, you made 47%. Okay? This is what this is telling you. Now, let me show you another example of, because you might think that was a one-off. Come on, that only happens once in a blue moon. Let me show you another example. And there is a mining company called Randgold. Now, this was highlighted 1 week in advance. It was highlighted in the newsletter saying that of the ones to go long, this is the best one. And look what it says. It says 100% of the times you received your money back within a week in this time frame in the last 4 years. But it also said in the last 4 years, you had a 0% chance of losing your money. Now, this represents a guarantee, practically. That's the closest thing to a guarantee I know, where literally 100% of the times you're going to make money and 0% of the times you're going to lose your money. 0%. This is, it doesn't get better than this, so let's be real. So let us see what this did in reality, okay? Because this is what the newsletter said in advance. So what happened a week later? Okay, so let me bring your eyes to here. This was the candlestick in question. Again, these candlesticks represents 1 day. So this is the day when we traded, and we can see this green line represents the top, the highest point it was. The red line represents the lowest price it was at. And if this was to fall, the first blue line would be the break-even point, and the second blue line would be your target exit. Okay. But in this case, this one had no interest in giving you anything on the short side. And if you look at that, in fact, let me just go back to that analysis. It said here, over here, on day one, in the last 4 years, 20% of times you'd made money on day one, but 0% of the times you made money on day two. So this is really telling you, you can't short this stock. You can't short it. It doesn't reward you if you short it. It only rewards you if you go along. All right? That's the historical data. Let's go back to that chart. So we knew in advance, we can't short this one. Forget it. We have to go along. And what does it do? All it has to do is give you your money and go back to the red line. Oh, sorry, go to the green line, which is the exit point for everybody. But it doesn't do that. It gaps up and takes you right up here to 74000, right up there before it settles back down again at a lower number. What kind of result does that give you? That gives you up to 89% return in 1 day. In 1 day, and we predicted. We didn't predict the 89%, so let me not exaggerate here. But what we did predict, that this was going to be a certainty in terms of giving you your money on the upside, certainly within a week. But this one did it really quickly. So this was equivalent of Usain Bolt breaking a world record here. All right. So talking about world records, what is the world record for getting your money back? Well, let me show you an example of a company you may be familiar with. It's a company called British Petroleum. And British Petroleum, this would have been the day before, and let's say this was your highest point. In fact, this was your highest point. And so you could have got here and got a good price, or you'd have gone here and you got the worst price because you paid the most money and the highest price for the stock. So when it went ex-dividend, the share price gapped down, and then it kind of bobs along, kind of doing nothing, and then it comes back to here, and then it starts to go on this upward trend, and it certainly happens here, and then by about here you get your money back. And then the question is, how long did it take? Well, let's look at the timeline. Timeline here says 9 o'clock. This is 8 o'clock when the market opens. 9 o'clock is 1 hour later. 10 o'clock is 2 hours later. And this represents about maybe 6 minutes past 10. So basically 10 minutes, sorry, 1 hour and 10, 2 hours and 10 minutes, you get your money back with this one, British Petroleum. Now this is the fastest I've seen a recovery. That's the fastest. Now, it was a normal recovery, because normal meant it dropped down and then bounced up. Randgold did not drop down. Randgold has gapped up. So Randgold beat this one, but Randgold was not normal. This is normal. It drops, then rises. Okay? So what I've shown you here is evidence that certain companies that pay dividends will reward you for doing so, and you can get your money back relatively quickly. You don't have to wait a whole year to get your money back. Okay, we've seen examples where you got your money back in 2 hours, or some examples where you've got your money back in 1 day with Randgold, and BHP Billiton, you got your money back in 8 days. Okay. Now, let's say it takes you 1 whole month to get your money back. That means you can do this 12 times a year, right? And if you can do this every week, then you can do it 52 times, would be the theory, right? But here's the reality. Me doing empirical studies on this particular phenomena, I've realized that this roughly, you can actually, this will do this and give you back your money 38 times out of 52. 38. Not 52 out of 52, but 38 out of 52. That represents roughly 9 months of activity. So for 9 months, this system works really well. And for 3 months, it's rubbish. It doesn't work well at all for 3 months. But for 9 months, it works really well. Now, if you was to just do this for 30 weeks, 38 weeks or less, I think most people would do pretty well out of this. When you bear in mind you're making returns of more than 20%. 20%. And even 20%, 12 times a year. You don't need to be doing much more than that to do well. Okay? So, let me change the subject slightly, because I want to talk about what you do with this phenomena. Because now you know the phenomena. I've shown you that it happens. What would you do with it? Well, you want to sort of mix this up with another concept called compounding. What is compounding? Well, compounding is the most powerful force in the universe, according to Albert Einstein anyway. So, I want to demonstrate the power of compounding, and so I wonder if someone would just put a hand up to be a volunteer to demonstrate compounding. Can I get a volunteer, please? Don't be shy. Don't be shy. All right, I'm going to pick on someone. I'm going to pick on someone called Joash Reed. Mr. Reed, can you unmute your microphone, please?
Can you hear me?
I can hear you very well. Joash, what I want to do with you, I want you to use you to demonstrate a point, if that's okay with you. And what I'd like to do is to ask you a question. And I want you to imagine first that a very wealthy investor decides that he wants to help you out with your investments, and he says he's going to show you a strategy that allows you to double your money every year. Okay, and your starting point is £1,000. How much would you have if you double your money after that period? After 1 year, how much would you have?
You have 2,000.
2,000. So let me show that here. So you double that 1,000, you've now got 2,000. Okay, Josh,
Okay.
if you double it again, what do you have?
4,000.
And double it again,
8,000.
and double it again.
16,000.
Once more. Well, not once more. Again.
32,000.
Again.
64,000.
Again.
128,000.
Again.
256,000.
Again.
512,000.
And last one.
1,024,000.
Thank you very much. Much appreciated, Josh. Thank you for helping me out there.
No problem. No problem.
Okay, so with Josh's help, I'm able to demonstrate the power of compounding. So I want you to notice this. When you start with £1,000, if you keep doubling consistently, and it doesn't matter what you do, you'll get this. So I don't want you to think this only works in the stock market. This works in the property market. This works in just anything. Anything you have the ability to double because you have the skill sets, or because you have the know-how, or the nous, or whatever, or the contacts, or the network. It doesn't really matter. If you follow this principle, compounding will become your friend, and it will make you very wealthy. Now, I want to quickly demonstrate something here, because a man a long time ago said, if I can live long enough, I know I can be rich. Okay, so I want to see what was it that Warren Buffett knew that most 10-year-olds did not know. Okay, what did he know? Because obviously he had a dad or some elder in his life that kind of helped him out a little bit. So what did he know? Well, he knew that 1 million became 2 million. 2 million became 4 million. 4 million became 8. 8 became 16. Da-di-da, da-di-da, da-di-da. Where do you get to by year 20? Well, let me show you. You get to 1 billion. 1 billion. So is it possible for someone starting with nothing? Now, I know 1,000 is a nothing, but in the context of this, it really is nothing. But if you can start with this, it will take you 20 repetitions of doubling to get you here. Okay, now I'm going to tell you about a man called Lakshmi Mittal. I used to watch him or pay attention to him on the Sunday Times Rich List, and I was watching his wealth go up and up and up and up and up. And you know what? I know by what factor it was going up every time? 100%. Now, you might think, oh, that's an accident. Well, I'm going to tell you, I had a business partner when we were involved in film financing. And something most people don't know, but Lakshmi Mittal basically invests in Indian films, okay? And I was involved in financing of Indian films back in the day, a long time ago. But my business partner was in that world, and I just happened to be their kind of finance person. And I knew that Lakshmi Mittal, he had a formula for investing. We knew this because his accountant, Lakshmi Mittal's accountant, told us his formula. Okay, and when you saw his results, you knew, or I knew, it was not an accident that his money was doubling every year. He was deliberately investing in things to create this phenomena. So, for those of you who are ambitious, you don't need to stop at number 10. You can just keep on going. Okay, but the key thing is here, you need time. You cannot do this quickly. You need time. Okay. And it helps if you're young. What does young mean? Young means you're in your 20s. So if you can teach this to your children, right, when they're like, I don't know, 6 and 7, 8 years old, when they get into their 20s, they know this stuff. And if you get them to be disciplined and they follow this pattern, even starting with something as simple as 1,000, and let's keep on doing this. And this is not money that they live on. It is spare money. They have a job. They live on their job money. But on the side, they do this on the side. And this is what is achievable. Warren Buffett, by the way, did exactly this. Now, in his case, he wasn't doubling. He was making a smaller percentage. but it took him approximately 60 years to do this. Okay, so it's possible. It's possible. All right. I want to leave that example alone just for a little bit, but that is the secret Warren Buffett knew, by the way, when he was a kid. Here's my question to those of you who are parents on this call. Do your children know this secret? And if so, and if not, when are they going to know this secret? When are you going to tell them? Because if you furnish this information in your child's mind, you are going to plant a seed that's going to be incredibly beneficial to them. Okay? All right, let's continue. I want to show you a formula that helps us to get to that understanding quite quickly. And the formula is this thing here. P, open brackets, 1 plus R, close brackets, to raise to the power of n. Now, this looks like hieroglyphics to most people, so let me break it down. The P stands for your principal starting cash. R stands for the rate of growth, how fast the money is growing. N stands for the number of times you repeat the process, and FE is the future value as a result of that activity. And in the example with Joash, we know that the principal was 1,000. So 1,000 goes in there. In fact, let me show you the next slide, so we just, instead of visualizing it, you can see it. So 1,000 goes in there. We know that the R was here, and that was 100%. So we doubled it, and doubling means 100%. And when you turn 100% into a decimal, it becomes 1. So for those of you who don't know how to convert that, I'll tell you. To make a percentage a decimal, you divide it by 100. That's it. Divide the number by 100, and that becomes that's that number decimalized. So 100 divided by 100 is 1. So that goes in there. You close the brackets, and then you raise it to the power of n. What is n? Well, we did it 10 times in that example. We did it once a year for 10 years. And that's that one. When you do that, this number falls out of the calculator. Okay? You might say, yeah, prove it. Here's the proof. 1,000, open brackets. Where's the brackets? Here. 1 plus 1, close brackets. There. And you raise it. How do you do that? You press this button. The X with the little square box. You raise it. Raise it to what? To the power of 10. Once you've done that, this number falls out. 1,024,000, which are obviously the number you recognize from before. So that is that one. So you might argue, in fact, I'll give you an example actually. A lady last week was really excited because she actually invested in a company called Taylor Wimpey, and she made 9% on a whole fund. So a whole fund went up by 9%, okay? And she was, saying she was pleased. And I said, do you know what that, and I said, 9% a week is really quite impressive. Now, I said, do you know what that really means? And she goes, no. And then she actually asked me, what do you mean by that? And I goes, well, how much money will you have at the end of the year if you took a money amount similar to this and you was to increase it by 9%? Do you know what you'd have? She said no. And so let's have a look what she would have if she did that. Now in her case, she didn't have 1,000, she had a £1,300 starting point. 1 plus this 0.9 is 9%. 9 divided by 100, that's what that is. And then remember I told you that the system that I'm going to show you, or I did show you, this only works 38 times in a year. So I'm now multiplying by 30 to be conservative, okay? So, and I'm going to assume that you don't catch all of them. You take a holiday and you miss some of the opportunities. But if that happened, you would have £17,000 just by increasing your fund size by 9% for 30 weeks. And that's it. So the next question then becomes, well, what happens in 2 years? Let's have a look. Same parameters, The only thing we change is this. We've got 2 lots of 30 to give us 60. What's she got? She's got £228,000. Okay, what happens after 3 years? Let's have a look. Same numbers, 1,300, 9%, and this time we've got 3 lots of 30. That's basically equivalent of 3 years. And what have we got? We've got £3,036,184. So you don't need a massive amount of money in terms of percentage growth to get something decent, as long as you do it for long enough and you do it often enough. Okay, so this is clearly faster than doing it once a year, 100% once a year. And this is a real example, by the way. It's a real example of what this lady achieved in investing in Taylor Wimpey. All right, and if she's on the call, I don't think she is, but if she was on the call, I would have gotten you to basically listen to her, because she would have told you herself. But I know she was literally dancing with happiness when she when I revealed to her this is a potential she could actually have if she just kept on going. And so the question is it worth it? Is it worth it to do this? That's your decision. All right, but all you need is discipline and knowing what to do. And I'm going to tell you this: if you guys don't care about doing it for yourself, please teach this to your children. Please, I'm begging you, teach your children how to do this. If they learn how to do this and you teach them, don't send them to school to learn this, you learn this yourself and teach your children, because they've got time on their hands, and compounding, one of the formulas for compounding is time. All right, do it for yourself, obviously, but please teach your children. If you do that, poverty is ended in your family. I promise you. If they do this, it's ended in your family. All right. Let me tell you what we've covered so far. And I'm going to speak very quickly now, because we've actually covered an hour already. Buying income producing assets. All right, and we know what that chart looked like, because we saw the asset chart. You buy income producing assets that go up in value over time. And then we looked at an asset type, one type, which is basically companies that pay you an income because you own them. And that income is called dividends. Okay, and so you receive dividends, and in this way, in this example, the newsletter that we actually take advantage of shows us the best opportunities each week, and only from the safest companies. So we absolutely want safety here. We don't want to buy a company that goes bust, and the top companies is unlikely, not impossible, but unlikely. And so we receive dividends from the best companies in the UK. And thirdly, we use the power of compounding. This is the key to this one, by the way. Doing this on its own and spending money, you know what? Yeah, you might have a nice lifestyle, but trust me, when you combine this with this, it's game over. It's game over. All right? All right. So what's the next steps? So what's the next steps now? Well, here we go. Here's your next steps. Every week, you research for yourself the best dividend fishing investment strategies, and then trade them. Just trade the best ones. And you can do it by yourself. So now that I've shown you what to do, you can just get on with it. Our subscribers typically make anywhere, depending on their fund size, anywhere from £120 a week to about £7,000 a week. Okay, some do a lot more, and I'm not sure how many people do less than that. I'm not sure, but I think this is kind of the bottom range. But you've already seen already, you don't need to have a massive amount of money in the beginning. What you need is you need to start it, and you need to do it for long enough. All right, and I've already shown you that mathematically 3 years gets you to a decent size. So let me tell you the reality. In reality, how long will it really take you? And the truth is, it will take you about 5 years. That's the reality. Okay, for lots of other reasons, which I can't really go into right now, but it will take you a bit longer than 3. But 5 years, 5 to 10 years, you're there. And how much work must you do to do this? Let me tell you what the work is. You press a button on your computer and you go to work. The next day, you can either set it up to sell itself, and so you automatically get the money, or you can close it out yourself and do it manually. And that takes all of 1 hour every single week. 1 hour a week. Is it worth investing 1 hour a week of your time in something that can make you financially free in the future? If the answer to that question is yes to you, then I suggest you get on with it and start getting good at this. And if it's not worth it to you, it's okay. It really is okay. It's all good. Another option for you is you could purchase the research that we do, because we do the research every week. So you can just get the research from an experienced supplier at a fraction of the cost of doing it for yourself. This saves you money and saves you time. Okay? And if you're an experienced trader, you've never traded before, we'll teach you. So not only do we give you this, but we'll even show you what to do if you've never done it before. There was a man I met on a conference I was at, and he was from Germany. And when I told him what I did, instantly he wanted my newsletter. Why? Because he knew this system. In Germany, they call it dividend stripping. In America, they call this dividend capture. And in the UK, I call this dividend fishing. All right. Now, he recognized the strategy immediately, and he said this is clearly an income strategy. His problem being in Germany is that he doesn't have access to all the inside knowledge of the British companies, but he can trade English companies from Germany, obviously, as we can trade from America and Germany from here. And he said to me, he was very interested in taking up my newsletter. Was he good to his word? Absolutely, because this guy is an experienced trader. He's been trading for years, and once he saw, and he didn't even have this presentation. He just basically heard me talk about it, and once he heard me talk about it, he was in. He was in. He wanted a newsletter because he knew, and he even said it to me. Why would he waste time doing the research himself? And he could actually do the research himself. He knew what to do. He said, why would he waste time when he can just read my my newsletter? And that's what he did. And if you're inexperienced, we'll even show you what to do. And so the long and short of it is you can learn a life skill where you earn while you learn. Okay? And so the bottom line is, if you choose to come with us and help and ask us to help you out, basically we'll do the research for you, so you don't have to. And that's the benefit of the newsletter. Okay, you might ask, well, what's the value of all of this? Well, this is the value that we believe it's to be worth. One day trading, and this is the program, by the way, if you're brand new. For one day, we bring you into a classroom, a physical classroom in a college, and you basically learn everything you need to know to basically make this your knowledge and your skill set. And we value that at about £2,000. When I learned this, by the way, in America, it cost me £11,000 for 4 days training. So let me just do that. 11 divided by 4, it cost me basically 2,700, right? So we're in a ballpark already. So I've actually paid this myself. But I'm telling you, it was worth it for me to learn it, because obviously if I didn't know, if you don't know, you don't know. And somebody once said, if you think an education is expensive, you want to try ignorance. Ignorance is more expensive than an education, no matter what you pay for an education. So let me just leave those words in your mind. And then the weekly newsletter. The weekly newsletter, we're valuing it here at 2,600 for 52 copies of the newsletter. And that works out to be the equivalent of £50 per newsletter each. And when you're considering you can make £7 a week, £50 is not really something that you're going to worry about. And then here, weekly 1 hour conference call. So basically a conference call very similar to this, in terms of, you looking at my screens as we're basically talking about what's going on. Once a week you get one of these in addition to all of that. And we value that at basically £100 because we're telling you what to do. We're telling you what the market's doing. We're telling you, the things that to watch out for. For example, tomorrow at 4 o'clock, Mark Carney is going to make an announcement, and that's going to make the market wobble. Now, these things you need to know about if you're going to be in the market. You just need to know these things, because unfortunately for us, when Mark Carney speaks, the market moves. and he's making the market move 4:30 tomorrow afternoon. And these things you get to know about, and we will tell you in this conference call. In fact, you'd even get it in the newsletter as well, by the way. And in essence, the conference call is really an audio visual of this. So you can, for those of you who don't like reading technical data, we just tell you, and we just simplify it all for you. All of that together is valued at £9,800. Now, we're not going to charge you £9,800. We're not even going to charge you £7,800. We're not even going to charge you £6,800, nor £5,800. We're not even going to charge you £4,800. Now, you're thinking, when is he going to tell us a price? Why put us in suspense? I'm going to tell you. It's going to cost you £40 a week. That's it. £40 a week. Multiply £40 a week by 52. You've got £2,080. Okay, so that's the annual expenditure. Now remember, I told you the guys typically make anywhere between £120 and £7,000 a week, and it's going to cost you 40 quid to get in the game if you come with us. If you do it for yourself, that's great. You can just get on with it because I've shown you the secrets, and you now know what to do. For those of you who are interested in going with us, here is we're going to give you an offer that we think is attractive. So that £2,000 we spoke about, we're going to give you option one. You can pay this in 4 monthly installments of £500. So it's basically pay £500 each month, and then 4 months later you're done, and you're in the game, and you get started, and you basically come on the class, and you learn what you got to learn. Apologies for that slight interference there. And then the second option is you pay the full amount in one single payment. And if you do that, we'll give you a 25% discount. And so therefore, you only pay £1,500. Okay? And that, I believe, is the end of what I'd like to say to you. And in fact, I know last time someone said to me, you know, can we speak to, in fact, can you give us examples of people who's done this before? Because, you know, Miles, you're a salesman. And that, by the way, that's not the truth, by the way. But, you know, you might be just a salesman giving us pre-talk. So let me see if I can find someone. Richard, I wonder if I can, Richard, can you unmute your microphone? Oh, brilliant. Richard?
Miles, can you hear me?
Richard?
Yeah, can you hear me?
I can hear you. Richard, do you want to just tell people your experience of being on this program?
Yes, of course I will, yeah. Very eloquently done, mate. Right, okay, so my name's Richard Purcell. I signed up to what you just heard actually in September 2015, and never traded before, totally inexperienced. Anyway, I went with the training class, and I had the conference calls, and Miles basically showed me how to place a trade, close a trade, and he showed me how to find the signals, notice the signals of the best and favourable time to place a trade. So that's what I did, and on the very first trade, started with a total fund of £6,000, and I invested 1/3, which made £677. So that was an 11.2% growth on the amount of money I invested. So I was blown away, absolutely blown away by this. I thought the potential where it could take me. So with my start-off fund and my bit of profit, I added a bit more of my own money just to round up my balance, just to make it to a nice bigger figure. So I increased it by another 700 quid, so I had 7,500, and I started trading with that. I quickly made, in the next 2 months, an additional £1,200. So I'd made 18% growth on my fund in 2 months. I added it to it again with another 2,000. So by November I had 8,800 of my own money, and by May I was up to 22,229 pounds, an increase of 13,406 pounds, and all of this in 8 months. All of this in 8 months.
Richard, thank
yeah,
you. Thank you very much, Richard, for that.
No worries.
Thank you very much for that. Portia, can I ask you to just give us your experience of what you have done?
I wasn't expecting that. Okay, so in my case, I had traded before, but not this specific strategy. And when I traded before, I traded currency and I didn't like it, so I sort of just walked away from that. And then when you introduced this to me in 2015, I started with a fund of 5,000 and got quite good at, I think I doubled my money because I was a little bit of a rogue trader in that I didn't listen to what you said about a third, I did 50%. So I very, very quickly doubled my money and I got quite excited. And so then I started telling other people, and they gave me money to trade for them. So I then ended up with 3 different funds on 3 different platforms, because I did actually know how to work the platforms. So I had 3 platforms with 3 funds. The first fund was 60,000. The second fund was 50,000, and the third fund was 15,000. Right. So the first fund, what I did is I took out 63,000 as I started to make money. I would take out money every week, but still leave it to compound, half of the profits to compound. So that got up to about 121,000. And then the second fund, I would take out for the 50,000. I would take out money each week and kept it at 50,000. So if I made 5,000, 6,000, 7,000, I would just take off whatever the profit was and give it back to the investor, so that the fund only stayed at 50,000. So that was like an income for him. So he was very pleased with that. And then the third one, the investors there, it was 2 investors, gave me £15,000, and I didn't touch it. They didn't want to touch it at all. But I went from 15,000 in 8 months, 7-8 months. I went from 15,000 to 52,000. So again, that was excellent results for all 3 funds.
Thank you.
So now what I've done is all of those funds are now closed, and I'm just now doing it for myself.
Thank you very much for that. So that's 2 examples of, and one was someone who was actually experienced and someone who was not experienced at all. And I'll tell you this, I don't know if Portia, I don't know if Portia has an advantage on Richard now, because Richard's basically caught up in terms of understanding. He's caught up. And so now, you know, and that would be the case anyway for everybody. Once you do something long enough, you just know what you're doing. Practice makes perfect is basically the way to go. All right, I think I'm done now. So if has anyone got any questions, now would be a really good time to ask. And before you do that, I'm wondering, is there anybody who's actually interested in what we've actually said? And if you can, if you're interested, can you show your hands? Let's just click on your hands so I can see who's interested. And while you're doing that, I'm going to unmute you. So if you've got any questions for me, now's a good time to ask it. Any questions? Don't be shy. Any questions?
Yeah, do you also charge by the week?
Who's asking that, please?
It's Cassandra.
Cassandra? Okay, the answer is, if we were to go that route, it would just give us way more administration than is necessary. And so we give you those two options.
Okay. Cool. Thanks.
Has anyone else got any questions?
Hello.
Hello, can you say your name, please?
Yes, it's Melville.
Hi, Melville.
I spoke to you last week. So, yeah. And I asked you last week, could this be done on the go?
I'm sorry, it can be done on the go. What do you mean on the go?
On the move, basically, as I'm traveling around.
I'm going to tell you this. I'm thinking of moving from England to live in another part of the world, because this is the kind of thing you can do anywhere in the world. Where once you've got decent internet, you have to have decent internet. So don't go somewhere where the internet's rubbish. Don't do that, because you can't do it.
Okay, no, I travel quite a bit, so this is why I asked that question.
I was in Spain, Granada, last Christmas, okay, around that time. And I was in the hotel and I was trading.
Okay, well, that means yes.
I was in the hotel trading from Granada. And I have a friend who decided to just go around the world. In fact, he decided just to leave. I mean, this friend, by the way, was a wealthy person. And he decided England wasn't what he wanted to do. And he went to France, and then he went to Spain, and then, in fact, he literally traveled around the world. And he was trading literally on the beach. Now, where he got the internet signal on the beach, I don't know. But he
I'm traveling, I'm talking more like the Caribbean, Central America, North America.
As long as you can hotspot your telephone, you can do this, because you can do this on your telephone as well. It's you can either hotspot it onto your laptop, or you can do it trade on your telephone. Because all you're doing is you're putting the trade on, and if you can't watch it, you can set up the signals to take yourself out of the trade automatically when it hits your exit point. But what I will also tell you, which Mars has probably just forgotten, we've just got a new trader that's joined the group. I can't remember how long he's been with us, but it can't be any more than 6 months. And he decided after 3 months to move to Ghana. And he's gone to a small village in Ghana. He hasn't got good internet there. So what he does is twice a week, he leaves the village and he goes into like the main city, and he stays there for overnight, and he makes his trade, and he communicates with us today as well. He makes his trade, and he goes back to his village, and he loves it. He said that the life there is wonderful, and he was living here in London.
That sounds cool. My last question is, how do one get to start this thing with you?
Okay. Well, the first thing you do is you put your hand up, Melvin, because I've not seen your hand up.
Oh, sorry. Okay. How is this?
There we go. Okay. Well, now that I know you're interested, here's what we'll do. We'll actually send you an invoice. Basically, I'll tell you what you do. Everybody who's put their hand up, can you please put your telephone number in the message box, and we'll just call you back up tomorrow.
Where's the message box?
The classroom starts. The next class starts on Sunday. This Sunday coming up, actually. And
I'm listening to you on two things, my mobile and also on my PC.
Excellent.
So contacts.
And that also is how you can actually do this trade on your PC and on your mobile.
Okay. So I'll send you my mobile number and my email address, just in case.
Yeah, just type them in, and so we'll contact you. And that's basically it. We'll send you an invoice, pay the invoice, and you're in the class. And so here's how it works. You're going to be receiving a weekly newsletter for basically for a whole year. So between now and next year, this time, you're going to be with us. We're going to be talking to you once a week on the conference call every Monday. We'll give you the newsletter by then as well. You can read everything that you have to read. And that's really it, you know. And you just do your trades. And like was said, his name's Frank in Ghana. I mean, and then there was another one. What's his name? Norman. Norman decided to go on holiday for 3 months in Barbados. He was trading in Barbados. You know.
That's good.
I've got people in America who's involved in this, and the guy in Germany, like I said before, there's a guy in Germany. I met him on a conference, and he's doing this. He's in Germany.
Yeah, because for me, it's healthy reason why I need to just basically get out of England a lot of the time. So it'd be good to be able to do this while I'm on the go.
I personally, I'll be honest with you, I cannot think of anything else that's easier to do than make money and then something like this. I don't know what it is. When I was an accountant, I was trapped in my job. I had to go in every single day, or they didn't pay me. Do you know what I mean?
Yes, I understand.
Whereas
Okay, well, I've just sent you my email address and my mobile number.
Wonderful. We'll be in touch with you.
Okay, all right. So have a good evening, all.
Thank you very much, Melvin.
Look forward to hearing from you soon.
Wonderful. Thank you very much. Is there anybody else got any questions before I let you guys go? Because I do know that I've gone over slightly longer than I wanted to. And I hope it was, in fact, was this useful to you? Was it useful, this information?
Yes.
Good.
Are you talking to me?
All of you.
Oh, well, to me, yes, it is useful, very useful.
Okay. And I would ask you to, once you've mastered this, please teach your children. And if you've gone beyond that age, teach your grandchildren, because this is how we're going to become free financially. You know,
that's my aim in life.
I mean, I'm begging you, please teach your children or your grandchildren, because this and get your family, at least set up so your family in future is no longer in the poverty trap that we just seem to be stupidly engaged in, because we don't need to be there. We don't need to be there. Once you understand the game of economics, you don't need to be there. And so learn the game and get good at it. And once you get good at it, teach your family.
Ooh.
Teach your family. Yeah.
Okay.
Lovely. All right. Any more questions? I don't want to preach anymore. I don't want to talk anymore. So is there any more questions anyone has before I let you guys go? Okay, fantastic. Well, thank you very much for your time and attention. And by the way, Barry, I see your hand was up. Is it possible that you could actually just put in your contact details so we can contact you? All right. Well, I want to thank you very much for your questions, your attention, and your time and your contribution. I want to thank you very much and wish you all a lovely, lovely evening. Take care, guys. Bye now.
Thanks, Miles. Bye.